What's up, guys? It's Dan from Coin Bureau Trading. Today I'm going to prove that you don't need Fed interest rate cuts or quantitative easing, aka QE, for altcoins to rally. If this is the kind of content that you enjoy, then be sure to smash that like button, subscribe to the channel, and ping that notification bell. Before we get started, do keep in mind that nothing in this video is financial advice. It's just my personal analysis of the crypto market. Your analysis could be different, and if it is, that's awesome, because the more difference of opinion that we have, the better traders and the better investors we're all going to become. So before I say anything, guys, I'll just quickly note that while Fed cuts and QE are not required for altcoins to rally, obviously it does help. So I'm not saying that it doesn't matter at all, but I am going to prove that it's not necessary, and this is actually pretty easy to prove in my opinion. And I'll start by just reading off a post that I recently did for members of the Coin Bureau Club in the research feed. So it's titled, "Reminder that Fed cuts and QE are not required for altcoins to rally." That's because in 2017, the Fed was raising rates and doing QT, quantitative tightening, like running down its balance sheet, but altcoins still rallied by 8x in 8 weeks. Whenever I point this out, I get macro and crypto counter arguments like interest rates being lower than they are now, when it's the relative change in interest rates that matters, and the relative change was technically larger in 2017, or crypto being mostly whales and retail, which it still is, and provably so. But why does everyone assume Fed cuts and QE are required for altcoins to rally? In the case of rate cuts, that's because lower interest rates means existing debts become easier to pay, which results in more money that can be spent on other things. The thing is that institutions and individuals locked in low interest rates during the pandemic, which is why rate hikes haven't slowed the economy so far, or the markets for that matter. In the case of QE, it involves buying US bonds. Like basically when the Fed does QE, they're literally just buying US government debt. This causes bond prices to rise and yields to fall. Since bonds are used as collateral in global finance, a rise in bond prices means that there's more borrowing and liquidity, like using those bonds as collateral. And since interest rates are priced off of US bond yields, a fall in bond yields causes interest rates to fall. As mentioned in previous posts, US bond prices and yield depend on supply and demand, just like every other asset. In practical terms, that means you don't actually need the Fed to do QE. You can have other large institutions buying bonds, like the Treasury with its bond buybacks, which it has been doing. Tariff revenue has also presumably gone towards buying back bonds, or at least reducing the need to issue more bonds. You even have stablecoin issuers buying up billions of dollars of bonds, which further has the effect of quote-unquote shadow QE. So if Fed cuts and QE aren't required for altcoins to rally, then what is? In short, a rise in global liquidity combined with enough certainty, like enough confidence from investors for this money to move into risk assets, and attention that brings that risk capital to crypto. All that's missing at this stage is attention, which you could debate with like all the stuff that happened with tariffs over the last week. But the point is, you literally just need three things: a rise in global liquidity, enough kind of confidence, certainty for investors to move that money out the risk curve, and then for something that brings that risk capital into crypto. And again, that requires announcements, that requires attention, which, as I've been saying, I believe is going to come as the result of an SEC exemptive relief order. But let's not get down that rabbit hole in this video. This is going to be all about macro. But anyways, guys, if you did enjoy that post, this is the stuff that I'm posting every single day in the Coin Bureau Club. That's where we do deep dives into promising small cap and mid cap altcoins every single week. Members actually get to vote on which altcoins we review. We have a research feed where I'm sharing insights like the one I just shared. We have a team portfolio page where you can see the altcoins we hold as well as the altcoins we're considering buying. We have an exclusive deals page where you can find discounts on crypto analytics platforms that will help you in your research. And we have a members Discord where you can ask us questions, criticize, whatever. You guys might have noticed a few people disagreed with this take here. But again, I'll be going through everything here in detail in this video, because this is actually a very nuanced topic, and people tend to, how would I say, it's basically just a narrative, like it's basically just a myth. And I guess we'll dive into it. So first things first, what you're looking at here, guys, is interest rates basically since 2012. You can see that in 2017, interest rates were actually rising. So again, interest rates are rising, but altcoins were rallying, crypto was rallying, there was no problem. Part of the reason why, and something I probably should have mentioned in that post, I think the reason why people assume that we need rate cuts for crypto to rally is because everyone is stuck in this 2021 mindset. But again, in 2017, interest rates were rising and crypto had no issues rallying, including altcoins. Not only that, guys, but you'll remember that in early 2024, we also saw a pretty nice kind of like you could say mini altcoin season crypto rally in early 2024. Interest rates were still really high. So this argument of, oh, well, it's because interest rates today are higher than they were back then. Well, they were even higher in early 2024 and altcoins had no issues rallying. So I'm sorry, but you can't make the claim in good faith that you need Fed cuts for crypto to rally. Again, of course, Fed cuts will help, but they're not necessary. And you can prove this, again, going back in 2017. And if you don't believe that and you think there's a whole bunch of nuances there and there's argument, fine. Let's go to early 2024. Same thing. Interest rates were way higher than they were in 2017, and altcoins and crypto had no issues rallying whatsoever. And again, same idea when it comes to quantitative easing, quantitative tightening. So as you can see in 2017, the Fed was actually slowly running down its balance sheet. Same idea. Crypto had no issues rallying. And you might say, oh, 2017 was different, whatever, blah, blah, blah. Okay, sure. Well, let's go, guys, to basically late 2023, early 2024, when the Fed was rapidly running down its balance sheet here, okay? And again, crypto had no issues rallying when it was doing an enormous amount of QT earlier last year. So why couldn't we see the same thing again? Again, I'm not saying that, of course, quantitative easing, of course, that would help with asset prices, but it's not necessary for altcoins to rally. That narrative, it is literally a myth. It is a narrative. You can prove literally with these two charts here that it's not the case. You can look back in 2017, and you can even look early last year in 2024 to see there were periods where altcoins rallied very hard, and it was a broad, altcoin rally when interest rates were high and the Fed was doing QT. So Fed cuts and QE are not required. And if you disagree, then feel free to let me know in the comments. But again, this is just an empirical fact as far as I'm concerned. Anyways, guys, so of course, going back to what I mentioned in the post, okay, if Fed cuts, why are Fed cuts basically and QE not required then? Because obviously, of course, again, like I said, it would help to have these Fed cuts and QE, but why are they not required? Why is this not as important as people are making it out to be? When it comes to the Fed cuts, guys, basically what happened is that individuals and institutions during the pandemic, they refinanced their debts. So basically what that means is that they basically borrowed money at a super low interest rate and they locked in that low interest rate for, I guess you could say an average of 5 years or whatever, which is part of why, in 2026, we're probably going to start to see a liquidity drain. But anyways, basically individuals and institutions locked in low interest rates. This is why a rise in interest rates has not affected the economy. And of course, it has been affecting, some portion of households, right? Especially on the lower end, people who are borrowing a lot against credit cards or whatever, or using credit cards rather. But again, people who own their homes, most homeowners locked in low interest rates, which is part of why the housing market is kind of frozen. And if you don't believe me, we can read it verbatim here from a great article from the New York Times, and I'll read literally just the first couple paragraphs if you don't believe me. The prediction was straightforward. This is from November 2023, by the way. The prediction was straightforward. A rapid rise in interest rates orchestrated by the Federal Reserve would confine consumer spending and corporate profits, sharply reducing hiring and cooling a red-hot economy. But it hasn't worked out quite the way forecasters expected. Inflation has eased, but the biggest companies in the country have avoided the damage of higher interest rates. With earnings picking up again, companies continue to hire, giving the economy and the stock market a boost that few predicted when the Fed began raising interest rates nearly 2 years ago. There are two key reasons that big businesses has avoided the hammer of high interest rates, in the same way that the average rate on existing household mortgages is still only 3.6%, reflecting the millions of owners who bought or refinanced homes at low cost terms that prevailed until early last year. Leaders in corporate America locked in cheap funding in the bond market before rates began to rise. So there you go. It's straight from New York Times. If you don't believe the New York Times, of course, we can go down that rabbit hole. But again, this is from mainstream media. This is from, and even here, what I was talking about, this is from Realtor.com. These are all mainstream sources. I'm quoting directly from the Federal Reserve's website. There's no conspiracies. There's no tinfoil hat anything here. This is just raw, concrete data reporting and analysis. Okay, so again, but this is just for the interest rates, right? So again, just to quickly recap, the reason why a rise in interest rates, why I guess you could say why interest rates matter less, or you could even make the argument don't really matter at all, is because a lot of households and corporations locked in low interest rates when they dropped basically to zero during 2020 and 2021. So that's why it hasn't affected the economy. That's why it hasn't affected the markets, and that's why you could even go as far as arguing that you don't need rate cuts at all for crypto to rally, which again is what we saw in early 2024 when rates were literally at their peak. That's when crypto was rallying, and you could say, oh, but it's because there was expectations of lower rates and whatever. Well, you can look at the 10-year yield, and it was actually rising during that time. There's no getting around it, guys. You don't need rate cuts for altcoins to rally. It's just provably false. Anyways, so this brings us to the QE part, and this is where things get very interesting and extremely nuanced. So pay attention, pay close attention. I'll do my best to explain it because it is a pretty complex topic. So again, just to quickly recap, what QE basically involves is the Federal Reserve buying U.S. bonds. And so in that sense, you can think that it like basically QE is literally just buying US bonds, and that is something that can be done, like I mentioned in the post, by anyone. It can be done by the Treasury, it can be done by investors, it can be done by stablecoin issuers, right? So there's you can have quote unquote QE happening from many places, not just from the Fed. And I know that's like very simplifying it. Some people in the comments might disagree, but I'm just trying to keep things simple to help people understand. QE means buying US bonds. This is something that the Fed, like, even if the Fed is like gradually selling, if there's other people that are buying more, then of course that can have basically the same stimulative effect. But there's another kind of nuance here, and I'll explain it just, this is a post actually that Arthur Hayes did, I think it was last year, and it has to do not just with the type of debt, but also the duration of the debt. So in short, guys, like you could make the argument that the economy and especially risk assets, they are affected the most, not by short-term interest rates, but by longer-term interest rates, by like the 10-year yield, which again is the 10-year Treasury yield. And as I mentioned in the post, basically bond yields determine long-term interest rates. So and again, the bond price determines the bond yield, and it's all based on supply and demand, right? So if there's a lower supply of long-term bonds, then the price logically will be higher, assuming the buying pressure stays the same or goes up, right? So again, less issuance of long-term bonds means that long-term yields basically stay the same or will go lower because there's the same amount of buyers or more buyers. I know, again, it's very complicated to explain, but again, there's basically just extreme nuance here in terms of the fact that the Treasury has been issuing primarily short-term debt since 2023, and this has basically resulted in less long-term bonds being issued, which has actually been keeping interest rates low, and as you'll see in a second, is technically the same as QE, and I will literally cite a research paper showing that. But first, I'll just read out what Arthur Hayes mentioned here. So on November 1st, 2023, Janet was Yellen. Included in the U.S. Treasury's quarterly refunding announcement was a proclamation that she would shift the majority of borrowing to Treasury bills, T-bills, which are sub 1 year in maturity. This enticed money market funds to pull money out of the Federal Reserve's reverse repo program and invest in higher yielding T-bills. The result, described in detail by in my essay "Bad Girl," was and is providing a liquidity injection that will total close to $1 trillion once it is completed. So again, like long story short, is by issuing short-term bonds, you basically were basically able to stimulate, like the Treasury was basically able to inject liquidity into the economy. This ties into a paper that was published in 2024 that some of you guys might have heard about. It's about it's quote unquote activist Treasury issuance and the tug of war over monetary policy. It was written by Stephen Moran, who actually works for the Trump administration now, and Nouriel Rabini, who's an economist. And of course, you might say, oh, like, might be rolling your eyes and saying, oh, you're citing like Trump people or whatever. But the fact of the matter is that this technically is correct. And I'll just read the executive summary, a little bit of the executive summary to just try and help you guys understand. So by adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them the economy, usurping core functions of the Federal Reserve. We dubbed this novel tool activist Treasury issuance, or ATI. By manipulating the amount of interest rate risk owned by investors, ATI works through the same channels as the Fed's quantitative easing programs. So again, like they're basically making the argument is like, look, by issuing primarily short-term bonds, it is functionally the same as QE, because again, I mean, you could make, again, now I'm going back to my own definition of like QE involving the purchases of US bonds, but just think for a second, what is the practical effect of QE? The practical effect of QE is that bond prices rise and yields fall. You don't necessarily, like, on the one hand, you have like the buying side, but you also have like the selling side, right? If the Treasury is issuing less long-term debt, then that basically restricts the supply of long-term bonds, causing their prices to rise, causing bond yields to fall, which has the same practical effect of QE. So whereas QE in the strict definition involves buying bonds, you can also have QE in the form of issuing less long-term bonds by restricting the supply and having the same effect on yields. I know that's very complicated, but again, I'm going to go through a few other sources here just to try and help you guys understand why, especially the QE aspect is not required. And I do think that the complexity of this topic is a big part of why a lot of people still think that QE is required for altcoins to rally when it's really not. And not only that, but the Treasury has arguably been doing QE. This kind of brings us to the modern day here in 2025. What some of you guys might have heard is that recently the Treasury announced that it would basically continue issuing lots of T-bills and would also increase bond buybacks. And what we're actually going to do now, guys, is we're going to listen to a short snippet from Arthur Hayes explaining this bond buyback dynamic, because this is another thing, like, again, like talking about QE. Again, QE involves buying bonds, and if the Treasury is doing bond buybacks, then that is basically having the same effect. But you might say, oh, well, technically not, because they're just issuing new bonds to buy back old bonds, but this still actually increases liquidity, and it is basically like a shadow form of QE. And Arthur Hayes actually explained this really well at the Token 2049 conference earlier this year. It's like I don't know, like a minute and a half or 2-minute clip. So I'm going to throw on my headphones here, and we're going to take a listen together, because this is, again, in my view, this is actually pretty underrated. Just for the record, like, I know Arthur Hayes gets some things wrong. I know that he recently sold a bunch of crypto because he's panicking. He's a little bit more risk averse, than the rest of us. Let's say, I would say, despite all his shilling of like meme coins and stuff. But just again, just because the guy's a little bit eccentric and gets some predictions wrong or whatever, doesn't mean he's completely wrong. And his explanation here is actually very good. And of course, it's like the most viewed part of the video. I do suggest giving this video a watch on the Token 2049 channel. Arthur Hayes Full Send: Why the Crypto Bull Market is About to Reignite. This was literally in May 2025. I think, I believe Token 2049 was in April though. But anyways, I'm going to throw on my headphones and let's listen together just to the, let's say, next minute or so of what he explains here with the Treasury buybacks.
And so if you don't understand buybacks, there's a very simple explanation. Essentially, it's a budget-neutral, supply-neutral way for the U.S. Treasury to influence how much leverage is given to marginal buyers of Treasury debt. And so what they do is they issue a new bond, they take those proceeds, and they buy an older bond. Now, this is important because there's a large section of Treasury traders, these hedge fund managers, and what they do is they buy a bond in the cash market, they sell a futures contract, and they wait for that very narrow spread to collapse. And if you apply a lot of leverage to that, you can make good money. So the gating factor in how much they can do, how much they can show up at the auction and buy, is how much leverage the banking system can give them. And on the banking side, a new bond that's liquid has a less capital charge than an old bond that's illiquid. So if Besson is able to take these old illiquid bonds off of these RVs trading books, then these guys can relever, go to the bank, get more leverage, create more money, show up at the auction, and buy debt at whatever price Besson wants to sell it at. So these RV hedge funds are the marginal buyer of Treasury debt, and Besson is doing all he can to make sure that they can show up and participate and make sure the U.S. government is funded at a very affordable level. And this is how liquidity is pumped into the market. So yes, technically speaking, a buyback is not quantitative easing. It is not money printing. It does not really influence the amount of dollars in the system, but the second order effects are positive for dollar liquidity and obviously for our bags.
So yeah, guys, I mean, I hope that kind of made sense. Again, like, you can rewatch that video if it doesn't make sense. But again, the key takeaway, as I mentioned in the post at the very beginning of the video, Fed cuts don't matter. QE doesn't matter because there's different ways of boosting liquidity with all this kind of like bond manipulation that is basically being done by the Treasury Department. All that matters at the end of the day is liquidity rising. And as you guys will know, and I'm sure you've seen all the charts on X or whatever, that liquidity is rising and is projected to continue rising into the end of Q3. And it's actually going to start contracting probably at the end of the year, at the end of Q4. And to really drive the point home, guys, I'll show you kind of like one more quick chart. This is from a recent interview that Michael Howell did on Monetary Matters. They're super awesome. Highly suggest following the podcast. Some really interesting guests on there. But as you guys can see, basically the black line here is global liquidity as projected by Michael Howell, who's kind of like an expert in global liquidity. And as you can see, like, he basically projects a global liquidity to peak sometime basically in Q3 of this year, and then it starts contracting later into the year. And he actually specifies this at the end of this video. He says, like, basically late 25, early 26, that's when liquidity is going to start being drained as this refinancing wall comes in. Because yes, all these corporations did lock in these low interest rates during the pandemic, but all that money is, they're going to have to roll over those debts, and that's going to drain liquidity, and that's going to start probably starting sometime later this year or early next year, which is why I'm personally not sold on a Q4 cycle top or a cycle top in Q1 of 2026, or in 2026 for that matter. But anyways, guys, again, key takeaway being is that Fed cuts are not required. QE is not required, especially because you have all these very nuanced dynamics around like Treasury, like basically bill issuance and long-term bond buybacks and stuff that's having the same practical effect as QE in terms of increasing global liquidity, which again is the most important thing. What is the thing that is the same between 2017, 2024, and now? That's a rise in global liquidity. And you might be wondering, okay, but how can I measure that, besides following these guys like Michael Howell? And I truly believe the simplest way to do that, guys, is to just look at the US dollar index at the DXY. You guys might remember that recently I was showing how if we look historically, that whenever the DXY falls, the first leg lower, that corresponds to a Bitcoin rally, second leg lower corresponds to an altcoin season. That's what we've seen every single time. And it looks like that second leg lower is going to be starting soon, like not in months, but in a matter of weeks here. And in case you're wondering why the DXY matters so much, that's because most debts in the economy, well, I guess to back up even more, most of the money in existence is technically debt. It's just money that was borrowed into existence, basically. And most debts are denominated in US dollars. So when the US dollar is falling, it becomes easier to pay back those debts, which means that there's more money left over to invest in other assets. And that kind of results in a overall increase in global liquidity and the buying of like stocks and crypto and whatever else, right? You can refer to my video on Monday earlier this week for more info there, because I kind of break it down, I would say, a little bit better. This video has been going on for quite a bit now. I do hope that all of that makes sense. I will be in the comments kind of answering your questions if you do have any questions. But yeah, if you did make it this far and you did find that information helpful, then be sure to smash that like button, subscribe to the channel, ping that notification bell, and I'll see you in the next one.